Well, hello and a very warm welcome to this Scope Ratings webinar, first half review and outlook for Italian NPL ABS. My name's Keith Mullin and it's my pleasure to be hosting today's session. I'm absolutely delighted to be joined today on the session by Rossella Ghidoni and Paula Lichtensztein from Scope Structured Finance team. In a moment, Rossella and Paula will take you through a presentation that will cover the principal factors behind the first half performance of Italian NPL transactions, and they'll offer an outlook for the remainder of the year. They'll also be happy to answer any questions you may have. To ask a question, please type them into the questions function on the right-hand side of the screen as we go through the presentation. And once the presentation is concluded, we'll move to the Q&A session. Now, some of you will know Scope's been publishing a monthly Italian NPL report, which tracks collection volumes across Scope's universe of rated transactions. At the end of today's session, we'll be making available as an exclusive to webinar delegates today, a link for you to download our extensive semi-annual Italian NPL performance report. I'll alert you to when that is available. Without further ado, that's it from me. We're going to kick off the presentation, and it's my pleasure to hand the floor over to Paula. Paula, the floor is yours.
Thank you, Keith. Good afternoon and welcome, everybody. We hope you find this webinar interesting and insightful. So let's start with a summary of our outlook. We expect that the sector's performance by year-end will be aligned with what we have observed in the first half of the year. Italian NPL collection volume seems to be stabilizing at 25% below average pre-pandemic levels. But the outlook is weak, with risk mainly to the downside. We expect Italian NPL transactions will continue to underperform in the medium term as the effects of the pandemic are not over yet. By the fourth quarter of 2021, we estimate that the share of transactions with collection volumes lagging services forecast will align with the second quarter figures. We also expect that the NPL Performance Index, which measures market aggregated cumulative net collections against the forecast, will remain below the baseline of 100 in the medium term, reflecting our expectation that transactions will underperform BPs at least for some time. Considering the speed of notes amortization observed so far, we project that notes will amortize in 6 to 8 years from now. The median profitability on closed positions stands at 85% below Scope's expectations. This metric still covers a relatively small portion of securitized portfolios because services have closed on average so far around 5.4 of original GBPs, around 6% of borrowers. So over time, profitability will become a more relevant metric as services progress their workout activities. Now, what's our forecast for 2021 NPL issuance? We expect issuance will reach between 14 and 17 billion, including transactions already closed in the first half of the year. Now, let's take a closer look at transactions performance against business plans. We selected a sample of 30 transactions which have at least one payment date as of May 2021. 18 of them are underperforming on a gross basis, while 16 underperform on a net basis. And we estimate that this picture will not materially change by year-end. Underperformance is mainly related to the effects of the pandemic. The various lockdowns translated in delays of judicial proceedings and the slowdown in economic activity resulted in the deterioration of debtors' affordability and liquidity conditions. You can see in the chart that there's some volatility on performance levels. On a gross basis, for instance, transactions cumulative collections go from minus 54% to plus 90% against business plans. This is because performance is not just a function of the overall market conditions, but also depends on the portfolio quality and the services ability. Some services quickly adapted to the new conditions and selected workout strategies that have counteracted some of the COVID effects. For instance, extrajudicial strategies like discounted payoff or note sales have helped in compensating for slower court proceedings, and we expect that this trend will continue in the short to medium term until courts fully recovers from backlogs. The suspension of inhabited residential properties auctions have also impacted portfolios with a high share of individuals with mortgage-secured loans. I will pass the word now to Rossella.
Thank you, Paula. So in this slide, we present the two indexes that Paula already mentioned in the first slide that we have developed to track the performance of the NPL sector. The first index is the SCI, so it's called Scope NPL Dynamic Coverage Index, and basically it shows the percentage of the senior and mezzanine notes that has been repaid on a yearly basis. So we use this index to infer which is the average remaining years needed for transactions to amortize, assuming that the annual pace of collections remains stable. The second index instead, the MPI, so the NPL Performance Index, simply represents the ratio between the cumulative proceeds so far of the transactions and the original servicer's cumulative forecasts on a net basis, so net of legal cost and servicing fees. The plus of the first index towards the second one is that, as you already know, while when we talk about the performance index, we know that servicers' business plans might differ based on the assumptions that the servicers apply in estimating the collections. The first index instead compares the collections with the outstanding liabilities of the transactions. So in a way, transactions through this index are more directly comparable than those that are considered by the performance index. If we move to the next slide, what we see is the trend of both indexes on the right side. The first chart represents the NPL performance index, so the index that tracks collections versus servicers' expectations. As you see, the index started above the threshold of 100%, but then it started to decline. And basically what happened is that more or less after the pandemic outbreak, it started to go below the 100% threshold, which means that, again, the sectors is clearly underperforming towards servicers' net expectation. Currently, the index stands at 94% of servicers' expectations, but in any case, as Paula mentioned at the beginning, our outlook is that the sector will continue to underperform in the medium term, which means, talking about the index, that we still expect the performance index to remain below the 100% threshold in the medium term. The second chart below instead represents the NPL Dynamic Coverage Ratio Index. As we mentioned previously, the index compares the yearly collections with the outstanding liabilities of the transactions, so with their senior and the mezzanine notes. What we can notice from the chart is that in any case, the index has remained moderately stable over time, which means ultimately that notes amortization has remained moderately stable. And this basically happened, especially after the pandemic, thanks to the structural features of the transactions, like the interest subordination events and the underperformance events, that basically in times of low collections, namely after the pandemic, triggered a faster amortization of the senior notes. Then clearly what we project, if you look at the blue dots here in the chart, they represent basically the translation of the index value in terms of years that are needed for transactions to amortize. So what we can see is that as of today, we see that overall transactions will amortize in 7.2 years. In any case, our projection is that, as Paula mentioned at the beginning, transaction will amortize in 6 to 8 years, based clearly on the short and medium term economic developments also. I would leave to Paula then to talk about the profitability.
So let's discuss now transactions profitability. You can see in the chart profitability of closed borrowers against scope B-case scenario assumptions for a subset of transactions with at least 5% of closed borrowers. As we were saying before, most transactions are underperforming versus our B-case scenario expectations. In the chart, you see that most transactions profitability is between 80 and 90%, and for this sample, only one above 100%. But again, this indicator is based on a small sample of receivables, as closed positions are still very limited. So we will still need to wait for more positions to be closed to draw more meaningful conclusions. As regards recovery timing of closed positions, services have been faster than scope projections. This is probably the result of some positions being closed with DPOs or with the sale of the credit strategies that typically front-load collections. Now, let's discuss issuance volumes. As I mentioned before, we estimate that total issuance in 2021 will reach between 14 and 17 million. If our forecast materializes, issuance will be quite aligned with 2020 and well below the 48 billion issuance in 2018. In the chart to the top left, you can see issuance's evolution since 2017, mainly after the GAC scheme was launched. This increase in activity is partly linked to the successful deleveraging of Italian banks. Since 2017, we rated 93 billion of NPL transactions, most of them under the GAC scheme. In 2017, the NP stock of the market was about 300 billion, decreasing to around 150 billion at the end of 2019. In the first half of 2021, 4 transactions closed for a total amount of 4 billion. You have the details of these transactions in the bottom chart. It's interesting to see that only one closed with a GAC guarantee. Surely, the activity in the NPL market has helped improving standardization of structural features and increasing transparency for pricing NPLs, and this surely fostered secondary markets.
So now we will move from basically our outlook to the analysis of the current performance of transactions. Here we present the major drivers for the under or over performance of transactions. What we have noticed is that among the major drivers for the underperformance of transactions, we have First, servicers that works on difficult onboardings on the portfolios, which ultimately results into a delay in the collections, in their servicing activities. Then clearly judicial proceedings, especially now, might drive the underperformance of some transactions, because what we know is that overall the timing of judicial proceedings, if compared to the extrajudicial ones, is longer. Really depends on the court, but overall it is longer based also on the type of judicial proceedings, but especially in 2020 and today, following the COVID-19 outbreak, we know that first the courts were suspended, then now courts clearly are not anymore suspended, but still, because they have equipped them clearly to work online, but still they have to recover and work on some backlogs coming from the period of the pandemic. So in a way now, judicial proceedings take even longer than prior to the pandemic. And clearly this could result into an underperformance. Another driver is related to the deterioration in borrower affordability and liquidity conditions that might impact the application of some extrajudicial strategies, for example, or some DPOs strategies. Then clearly the real estate market has been impacted following the COVID-19 outbreak, which means that some assets also got materially depreciated following the pandemic, and this was reflected also in the context of the auctions, for example, on the judicial proceedings. Finally, also the application of massive note sales conducted with high discounts can be a driver for underperformance if basically the receivables are sold with higher discounts than what the business plan forecasts, basically. Instead, as major drivers for the overperformance of transactions, we can have, especially in the first periods of a transaction, cash in court proceeds that are collected faster than servicers expect, or proceeds coming from loans that were already in advanced legal stages that in any case were resolved faster than expected. So in a word, the faster timing of collection of advanced legal stages and cash in court proceeds might drive the overperformance. Clearly also the sale of assets above expectations, which may result from the conservative appraisal of some properties, might drive an overperformance. And also clearly the servicer's ability to reach extrajudicial agreements that may result in the front load of collections compared to basically the original judicial forecast, because business plans are typically crafted on a judicial basis. So clearly every time, let's say, a servicer applies an extrajudicial agreement with a relatively fast timing, this might drive an overperformance. And then clearly borrowers' improved financial standing could drive some overperformance. Then in the next slide, what we present instead is our view on the monthly volumes of collections. As Keith already presented at the beginning, we have this monthly publication on how the NPL securitizations have been impacted by the pandemic, where we typically compare the monthly collections with the average pre-pandemic collections. The outlook that we are presenting today is fully aligned with our monthly report, because what we have basically already presented in the latest report that analyzes collections until May of this year is that in 2021, volumes have been less volatile than in 2020. However, we see that volumes are still 25% below the pre-pandemic average, which is somehow aligned with our analysis on the current performance of the transactions. So at the end, we can argue that our view is that in any case, in the medium term, volumes will remain subdued, because in any case, we foresee these risks to the downside, because basically the, let's say, new COVID-19 variants may force the Italian government to tighten again the measures, and therefore we expect that the volumes of transactions, collections will still be impacted by the pandemic. I would leave to Paula now on a more detailed overview of the transactions performance.
Okay, we will now provide an overview of the performance in the first half of 2021. In this table, we summarize some key performance metrics and indicate whether the transactions are currently under or overperforming in respect to each of them. The first indicator is the transaction's profitability versus Scope B case projections. The rest of the indicators are linked to the services projections. The last column simply indicates whether a subordination or underperformance event has been triggered in the respective transaction. These triggers, a time of low collections, as Rossella was saying, accelerate the amortization of the senior notes protecting Class A note holders. Most transactions are underperforming services' original projections, that is, actual cumulative collections are below servicers' initial estimates. But most transactions show good profitability on closed positions if compared with servicers' target prices. This is the column for the NPVR, which is mostly over for most transactions. However, the majority of transactions are underperforming in terms of profitability when considered scope projections. This is partly explained by the fact that, unlike the NPVR, we do not consider any discounting effect for this metric. This is just the second part of the table, which more or less replicates what we were discussing before.
Yeah. So now we describe basically how is the current transactions performance benchmarked against services business plans projections. In the next slide, we will show you some charts with the detailed historical trend of these two ratios. But let's first start and explain which is the meaning of the ratio that we're going to present, and then analyze which is their historical trend. So in the next slide, we will present two charts. The first one is related to the cumulative collection ratio, CCR, that is, let's say, the official ratio of transactions on which the events like the interest subordination or the underperformance events are linked. And basically, the cumulative collection ratio is the ratio between the realized cumulative collections over the business plan expectations. This ratio is typically computed on a net basis, so gross collections minus basically legal costs. However, we shall highlight the fact that the way in which this ratio is defined across transaction is not uniform, because in certain transactions, the ratio is computed simply on a gross level, while in other ones it is computed also net of legal cost plus servicing fees. So it's true that is the official ratio for the transactions. However, we should be reminded that it is not strictly comparable across all transactions. Then the second ratio that we are going to present is the net present value profitability ratio. Paula already mentioned it before, but basically this ratio is computed only on the positions that have been closed by the servicer. So only for those positions for which the servicers do not expect any further collections to come. And is basically the ratio between the net collections allocated to the borrower and the net recovery proceeds that were expected by the servicer in the business plan. The metric is computed then on a net present value basis with a certain discount rate. One thing that we want to highlight here is that, as we will see, these NPVR ratios are generally above 100%, which means that if we compare the profitability of closed borrowers versus servicers, it is quite good. However, if we compare their profitability versus our expectations, as we already saw before, we see an overall underperformance. Because before, what we mentioned is that on these closed positions, basically we see collections that are 87% of our B case assumptions. In any case, if we move now to the next slide, the first chart that we can see is the chart on the that depicts the historical trend, the cumulative collection ratio for all the 30 transactions. So in the horizontal axis, you see the quarters since closing, and then in the vertical one, you have the value of the cumulative collection ratio. Now, what you can notice looking at this chart is that for each quarter, the median value of the CCR has been declining. So it started from, let's say, 115%, and then it started to decline. And now, let's say in the latest interest payment date, it is between 80 and 60%. Now, the point is that we see this declining trend of the cumulative collection ratios. Mainly, we can argue for two reasons. The first reason is that clearly, if we think about the time in which the transactions were issued, we have to distinguish between those transactions that were issued prior to the pandemic and those that were issued after the pandemic. Why this? Because simply services projections in the business plans have been more conservative now after the pandemic rather than before, prior to the pandemic. And since the business plan's projections represent the denominator of this ratio, this clearly impacts the value of the CCR. So, in other words, what we are currently seeing is that the CCRs of those transactions that were rated after the pandemic have been more resilient versus those ones that were rated prior to the pandemic. So this is let's say, a major difference. Another point to be highlighted is that in the initial periods of a transaction, typically what happens is that we have these cash in court proceeds, and if they are collected with a faster timing than the servicers expect, this results into an initial overperformance for the transaction that, however, gradually, let's say, fades away as long as the cash in court proceeds are already cash in. So sometimes what we notice is that the CCR starts with a very high value level, but then gradually starts to decline, basically over time. Now, if we move instead to the next slide, we will see the chart that represents the historical trend of the net present value profitability ratio for all transactions. As I mentioned before, what we can see here, especially looking also at the median values per quarters, is that overall transactions are showing a good profitability versus the services expectations. Still, we have somehow a volatile trend because we see some outliers in terms of profitability. However, as Paula already clarified before, the NPVR takes into account the actualization of the cash flows. So from our perspective, if instead we simply compare the proceeds versus our expectations, this, let's say, overperformance is actually not there, and we see instead an underperformance. I would leave now to Paula to talk about the recovery strategies.
Thank you, Rossella. Services follow different recovery strategies, such as judicial claims, DPOs, and note sales. The choice of the strategy generally depends on the portfolio characteristics and on the economic considerations to maximize loan profitability. So far, the core recovery strategy has been the judicial route. Despite the legal proceeding suspensions that we were commenting before and delays following the COVID outbreak, almost half of the proceeds still come from judicial proceedings. Then DPOs represent 26% of proceeds, followed by an 8% for note sales. And with note sales, we mean the sale of a portion of the securitized portfolio or of a single credit. A steep increase of note sales may be a warning signal of poor performance. Selling credits can help front-loading collections, for instance, when judicial routes take longer than expected and transactions volumes are poor. But we monitor, and it's important to monitor if these portfolio sales are done at big discounts, because this might be detrimental to the transaction in the long run. Also, indemnity proceeds have been limited so far, or even inexistent for many transactions. But it's important to consider that high indemnity proceeds is an indicator that the portfolio information at closing was not accurate, and this may impact services' original strategies and business plans' accuracy. Finally, other recovery sources such as REO sales through REOCO structures or the execution of guarantees such as Confide have been adopted only occasionally. Let's take a look now at the level of recovery expenses. Recovery expenses are mainly composed of servicing fees and legal costs. On average, servicing fees are around 59% of total costs, and legal costs, the remaining 41%. The choice of the recovery strategy is an important driver of expenses, as some strategies are costed than others. For instance, note sales cost significantly less than judicial proceedings. As we can see in the chart to the left, recovery expenses vary across transactions with an observed median recovery expense ratio of 1.6% in the first interest payment dates that progressively increased to 5.3% later on. In any case, so far overall, services have sustained recovery costs that were below their original projections, with median values varying between 35% and 70% of the original projections. This can be explained by several factors. First, as Rossella was mentioning before, in the initial interest payment dates, recovery strategy expenses are typically low, as services are mostly focused on the portfolio onboarding process, which may delay the proper workup of the practices. They might also focus on cash in court proceedings, for which most legal expenses have been already sustained. The second factor that we can mention is that part of the legal expenses are paid in later stages of the legal proceedings. Therefore, recovery expenses will probably rise in subsequent periods as workout strategy progress. And finally, business plans are generally constructed assuming cost levels of judicial proceedings. So the cost levels that they factor in the business plan are those of a judicial proceedings. However, a material share of actual recovery proceeds have been from DPOs and note sales, as we were seeing in the previous slide. And these have lower associated costs. So these also contributed to costs being so far below what services initially forecasted.
In this slide, instead, we present an overview on the structural performance triggers for the transactions. So basically, in the table below, what you can see for each transaction, based on the color of these dots, is whether or not at a specific interest payment date, the transaction experienced either an interest subordination event or an underperformance event, or both events. What we can easily see, even without going into the details of each transaction, is that a material share of transactions actually experienced either one of the two events or also both events. So 14 out of 30 transactions have reported actually the occurrence of these events. And actually, once one event occurred, what we notice is that the event continued to occur also in the subsequent payment dates. What you may already know is that the underperformance event typically results in the deferral of part of the servicing fees, while the interest subordination event results in a faster amortization of the senior note versus the mezzanine note, because basically first the interest on the senior note are paid, and then its principal has to be amortized in full until you start to pay the interest on Class B and to amortize the principal on Class B. Actually, let's say this thing of seeing so many transactions that have experienced these events is actually aligned with what we were explaining in the previous slides, where we were showing basically the trend of scope coverage ratio index. If you remember, what we were saying is that the index behavior was moderately stable, namely that the notes amortization has been relatively stable, and actually, again, that was linked, was supported by the fact that these events supported a faster amortization of the notes, even if after the pandemic, collection volumes basically materially reduced.
Maybe, Rossella, I can add on exactly on these 2 points. The first one is that the first index that we constructed, which tracks cumulative collections, tracks net collections, and whereas the CCR not necessarily tracks net collections. It depends on the transaction. So this was a way of standardizing the reporting and the tracking of performance. And the second point of what you were saying on the performance triggers, that it's interesting to see the interaction of these triggers behavior and the amortization of notes. And I would say that maybe the most relevant one is the Class B interest subordination, because typically coupons are relatively high compared to the overall securitization, obviously, but also compared to the Class A. So there's a lot of savings for the structure when you hit this trigger. It's detrimental to Class B note holders, but clearly it protects quite importantly Class A note holders, as they are repaid principal before Class B interest is repaid.
Yeah.
Okay,
I
so
think we
Rossella,
reached the end of the presentation.
yes, indeed. So thank you very much, Rossella and Paula, for that very detailed presentation with lots of very valuable insights. So I mentioned at the beginning, we're going to move to a Q&A session. So if you have any burning questions that you'd like to put to Rossella or Paula, please type them into the questions section on the right-hand side. So I've got some questions here already. So let me kick off straight away. And perhaps, Paula, I could ask you this one, which is, you talked about services and the closed borrower profitability. My question is this, really, why have services closed such a low number of borrowers so far?
Yes, of course. Well, let me start saying that a borrower is closed once the servicer expects no further collections. So this is partly an accounting decision and an internal decision of the servicer. First is that transactions are relatively young and judicial proceedings take years. Also, the pandemic negatively impacted the judicial timing. That is, court activity was suspended and they still have to recover from the backlogs. Servicers try to compensate these delays via extrajudicial or note sales, as we were mentioning before, but these are dependent on market and borrowers' conditions. And the judicial route seems, however, to still be the core strategy. As we were seeing before, around 45% of proceeds still come from the judicial route. Another relevant factor is that from a technical perspective, in case of secured exposures, once an asset is sold, the position is not necessarily closed because the proceeds from the sale might not have covered the entire debt. And this is what we call security shortfalls. And servicers, depending on their strategies and the economic decision, might still try to recover the shortfalls. And in this case, they will keep the position open. Having said that, the monitoring agent has to verify on a sample number of closed borrowers that the servicer has closed positions in a timely way. And this is to avoid any distortion for the MPVR computation, which is the profitability, and for the servicing fees computation, because typically they are deferred if there's any underperformance of the MPVR or the CCR, depending on the transaction structure.
Okay, thanks. Yeah, that makes sense. And Rossella, let me come to you on this one. Again, picking up on a point that was made during the presentation, which was, obviously, since the pandemic, I guess, conditions have changed. Have services applied greater stress to evaluate their portfolios since the pandemic outbreak?
Thanks, Keith, for the question. So I would say from a high level, yes, because basically what we have been seeing so far after the pandemic is that servicers started to craft more conservative business plans than what they were doing before. And after the pandemic, the business plans were, let's say, more conservative, both in terms of timing of collections, but also in terms of, value, total, the final, let's say, recovery rate of the portfolios. So what we have seen is that typically servicers have lengthened their time to recover between 6 months and 1 year, sometimes even more than 1 year. taking into account at the beginning, as we mentioned, the suspension of the courts, and now the backlogs that that has come after the court suspension. Now, the second point is that what we have seen is that servicers have also stressed their security value haircuts. And they did that because basically, every time when they analyze basically the historical data of their sales, clearly their historical data is not covering for a sufficient time span what happened after the pandemic in a way. And that's why what they did is that they typically added new haircuts to the previous ones that were, let's say, the more standard ones based, on the property type, on the valuation type, etc. Because basically the main argument was that clearly now the real estate market has been impacted by the pandemic. However, their historical data was not really, reflective of this, because actually it's just 1 year since the COVID-19 outbreak occurred. Having said that, what is important to highlight is that still today, servicers are applying the same conservative business plans as 1 year ago. We notice it from the wall of the business plans and from their final recovery rate. And their view is that still we are, let's say, in the middle of the pandemic in a way. So at least for this year, they will continue to apply more conservative business plans, basically.
Right, okay, thank you. I've got another question here, and which is really to do with your outlook. And you said that you expect that by the end of this year, that underperformance will be aligned with the first half, which what you said was tracking below pre-pandemic levels. Just to be clear, can you clarify? So are you saying you expect NPL monthly volumes will continue to track below pre-pandemic levels? This is going to continue for the next few months. I don't know, Rossella, maybe you want to kick off, and Paula, maybe you can add.
Yeah. So yes, this is correct. So basically, as we previously mentioned, let's say what we see is that currently transactions are lagging behind the services projections, 25% below actually. This is reflected also by the trend of the monthly volumes of the transactions. What we have highlighted before is that this year the volumes have been relatively more stable, let's say less volatile than last year, but still they are below the pre-pandemic levels. So we let's say still expect that by year end this trend will continue, because basically our outlook remains weak. Even for the second half of the year. And as we mentioned before, we still think that there are some risks brought by these new COVID variants that, might drive the government to tighten again some sort of lockdown measures. So yes, this is even on the monthly basis, we expect that volumes will remain subdued by year end.
Okay, thanks. Paula, I'm going to ask you maybe to add a couple of things. But before you do, can we make the download available for the 6-monthly performance report, if that's possible? So you can click on that and you will get access to the semi-annual performance report and outlook, which, as I said before, is an exclusive to webinar delegates. So while you do that, Paula, would you like to add some closing comments on expectations between now and the end of the year?
Yes, actually, one additional point may be interesting is that still we expect some, let's say, seasonality. For sure in December, because typically, and this is quite clear in 2020. Unfortunately, we don't have the chart monthly for 2019, but in 2020 you see that collection seems to skyrocket in December, and this is linked to investors closing the year, balance sheet being closed, incentives of services as well, maybe some individuals receiving some cash to close or to accept some DPOs or payment plans with a lump sum initial payment. So we still expect this trend, but we might typically it's a very low month, whereas June and July usually are also high level months.
Okay, I think we're running into school.
Another point, I don't know why there's a lot of noise in the...
There's some very severe interference there, so yeah, I think it's...
Yes.
So carry on, Paula.
Okay, good. The last point I wanted to make, and this is something that we highlighted in our monthly report, is that it was quite interesting to see that, like, judicial proceedings, judicial proceeds from this type of strategy have been relatively stable in the sense of share of the proceeds of total collections, whereas DPOs and note sale have been kind of like interchanging each other. So when DPOs increase, note sales decrease, and vice versa. So let's see if this also continues over time. But it seems like services have been taking one or the other strategy alternatively, depending on the economic conditions and to maximize the proceeds of the alternative ways to the core strategy, which still is the judicial route.
Okay, thank you very much, and apologies for that background noise there. But there are no more questions coming up in the question facility. So in which case, I think it's I can close the session now. So I'd like to thank Rossella and Paula very much indeed for your contributions today and your time. Thank you in particular to those of you who dialed in and stayed with us to the end of the session. I've had a couple of questions as to whether the slides on today's presentation will be available. The answer to that is yes, and I'll figure out, maybe not on this session, but we can always follow up with you after the session via email or make it available some other route which we'll communicate to you. And I hope you managed to download the semi-annual report in time. If you didn't for any reason, it will be available on the Scope website, scoperatings.com, at some point over the course of tomorrow morning. So on that note, I'd like to thank everyone again for their time. NPLs is one of many of Scope's specializations, so I feel very confident in saying that we'll be back for more on Italian NPLs at a point later in the year. So for now, thank you again, stay safe, and goodbye from us.
Thank you.
Thank you very much. Bye.